Interest rates can only go three ways, up, down, or sideways, but which way are they headed in 2025? With mortgage rates sitting at critical levels, waiting for the perfect time to buy could end up costing you thousands. So the key is to make sure that you're ready when the next shift happens. In this video, we'll break down what's driving mortgage rates, what could push them up or down, and where they're likely headed in the 2025 housing market. Now I'm going to give you the key takeaway right here as we start this video, and that's that interest rates are likely headed lower, but the key is probably not in a linear fashion. In fact, if I had to guess, I think interest rates are going to look a lot like they did in 2024, where you see interest rates come off the peak to lower levels, and where it looks like everything is rosy and getting better again, and then all of a sudden they move back up. And that's because there's still a lot of volatility out there in the market, and that's one of the things that we're going to talk about as we discuss my interest rate forecast for 2025. I think it's important when talking about interest rates to talk about what actually affects mortgage rates. There's this belief out there that the Fed controls mortgage rates, when in fact, they don't control mortgage rates at all. They only control the federal funds rate, which is a short-term interest rate between banks lending money to one another. And the reason I bring this up is because I'm often talking to people talking about holding off on locking an interest rate, holding off on buying a home, because they've heard that the Fed is going to lower interest rates at some date in the future, with the belief that as the Fed lowers that rate, that it's automatically going to impact their interest rate. So if the Fed lowers by a quarter or 50 basis points, that means their 7% rate is now going to be 6.75 or even 6.5%. And that couldn't be further from the truth. They don't control mortgage rates, but rather they control things that affect mortgage rates, with two of the big drivers being part of their dual mandate, which is number one, price stability, and number two, to maximize employment. Now you're probably wondering, what are we talking about here with price stability? The Fed ideally wants to see the economy growing somewhere around 2% annually, which means an inflation rate of 2%. And that's because ideally they want to see an expanding economy, but they don't want to see one where prices are completely out of control, which is essentially what we saw post-COVID, with inflation hitting as high as 9.1%. And that's part of the reason that the Fed hiked the Fed funds rate so much during the last 2 years, is to slow the economy, to slow the growth of the economy, not necessarily to bring prices down, but rather to keep prices at a point where they're continuing to go out of control. And for the most part, it looks like they've accomplished now. But the second part of their mandate is to maximize employment, which ideally means to keep unemployment low, where everybody out there in the market that wants a job has one. And based on the latest job numbers, it looks like the Fed is accomplishing exactly what they had intended to do, which is ultimately leading to this idea of a soft landing, which means lower inflation, jobs market is still strong, and the economy is still growing. Now notice, nowhere in there did I mention anything about the Fed controlling interest rates, wanting lower rates, wanting higher rates when it comes to mortgages and the home buying process. So when we're talking about what affects mortgage rates, we're essentially looking at the economy and what's likely to happen to essentially give us some insight on where mortgage rates are headed. So for all of you people out there hoping for super low interest rates again, then you have to be hoping for a much slower economy, a recession coming, people losing their jobs, which in theory is a double-edged sword, because yes, you want lower rates because that allows a lower monthly payment. It allows improved affordability, but none of that stuff matters if you don't have a job. And that's because in a really slowing economy, one where you see mortgage rates, that means that a lot of employers out there are probably laying off people. And on the flip side, if you're someone that thinks higher mortgage rates are coming, that we're going to see interest rates at 8.5, even 9%, then you're somebody out there looking at the economy thinking everything is super rosy, that we're going to continue to have super strong inflation, that we're going to continue to have really low jobs numbers, and that we're going to have this huge expanding economy where businesses are growing at a rapid pace, which also isn't a good thing because that likely means higher prices in everything that you're buying. So ideally, you want somewhere in the middle. You want not really a super slow economy, but not a super strong economy, one that's essentially growing at the Fed's preferred target of around 2%. So going back to where I started the video saying that interest rates can only move one of three ways, which is up, down, or sideways, let's start by talking about which would actually cause interest rates to move even higher from here. And as I mentioned a moment ago, it's really better than expected economic news. One where inflation is going up. One where we have this expanding economy with stronger than expected retail sales, stronger consumer confidence. One where there's plenty of jobs out there where somebody can leave one job go find another without any problem at all, and likely at higher pay. In addition to that, as mortgage rates continue to get worse, you're likely going to have worsening spreads between the 10-year and the 30-year, which is also going to impact rates even further. And the last thing that could cause interest rates to move up are things like geopolitical events like wars or trade disputes that more or less increase volatility out there in the market. As there's more volatility in the market, you essentially have less transparency as to the direction that things are moving, and many times this can affect interest rates in negative ways. Now, if interest rates do go up further, what does that mean for house prices? Well, in my opinion, if you see interest rates continue to climb, that means you're going to see inventory continue to grow on the market. There's just going to be less people out there that can buy these homes. Affordability is going to be worse. Now, you're not going to have a flood of homes come to the market because there's still people with super low interest rates that aren't willing to give them up. But you are going to have inventory continue to grow. As inventory continues to grow, you're going to have more and more softer markets out there across the United States. Remember, all real estate is local. So we've already had softer markets down in Florida and Texas and, Arizona and Austin and some of these different areas where inventory has grown, prices have pulled back. If interest rates go higher, that means more of that. Now, it's not going to be the entire United States, everything slows down, because there's still pockets up in the Northeast that have super low inventory, and higher rates, it's going to allow inventory to build, but there's such a lack of available inventory out there, probably going to have less of an impact. And remember, every 1% that interest rates climb, that takes away 4 million buyers out there in the market. So that means less competition out there in the market. That means the market's more in favor of buyers. Negotiation is more in favor of you. And it also means home price growth is going to be affected. That means instead of home prices climbing 3.6% like they did in 2024 in a slow market, if interest rates climb even further, you're going to have home prices at 2, 1, 0%, potentially even negative in some markets out there. But here's the thing, I don't think interest rates could or will climb high enough to cause a crash out there in prices. It's just more of an overall slowdown than anything else. But on the flip side, what could actually cause them to go down? We actually want to see inflation coming down more than expected, closer to the Fed's 2% target, which also means retail sales and consumer confidence coming in less than expectations, along with unemployment getting worse, people losing their jobs. If we see the unemployment rate go from the low 4% upwards of the high 4%, low 5% range, then this is a sign that the overall economy is slowing, which in theory would be a really positive thing for mortgage rates. And as we mentioned earlier, that spread between the 10 and the 30 year would likely improve as mortgage rates improve. So as mortgage rates decline, that spread improves, which allows mortgage rates to improve even further. And at the moment, we're sort of in this inflection point in the market where news has been good, it's been bad, it's been bad, it's been good. It's kind of been bouncing all over the place. And that's one reason that we saw interest rates climb into the spring of last year, peaking sometime between April and May. And then we saw them decline, and we all thought things were better, that mortgage rates were going to continue to improve, until all of a sudden they didn't and started to climb even further. And I think that's why it's really, really important to understand that volatility probably is the new normal for 2025, and that interest rates aren't going to move down in a linear fashion. So while you should expect pockets of lower rates, you should also expect periods of volatility and increases in rates. And if you're someone out there considering buying in this market, you shouldn't be sitting there trying to pick the top or the bottom in the rate, but rather you should start the process by buying when it's the right time in your life, and understand that the rate that you're closing at might be your interest rate for the future. And the reason I point this out is because there's a lot of people out there saying, buy the house, date the rate with this expectation that interest rates are going to automatically decline. In fact, it's some of the worst advice out there in the market, because there's people that did that back in 2022 that still have their super high interest rate because they weren't in a position to refinance, or when interest rates dropped lower last year, they thought that interest rates were going to continue to drop, so they held off on the sidelines waiting, and then all of a sudden rates went back up. So my advice for anyone buying in 2025 or trying to refinance is to take advantage of the rate dips rather than trying to time the market. As many of you know, I purchased a home back in November of 2023 when interest rates were near their peak. Now, I didn't like the interest rate that I was getting at that time because it was much higher than the interest rate on the home that I just sold. But the key is I was comfortable with the payment. I didn't like the payment, but I knew that I could continue to make that payment even if it never improved, even if if that was my payment for life. But fortunately for me, interest rates started to decline right after I closed on that home, and I was able to refinance in the early part of 2024 and drop that interest rate 0.5% at that time. And then, fortunately, I was able to do it again come August, September when interest rates dropped even further, and I was able to drop it another 0.5%. So I was able to refinance 2 times to a full 1% lower than where I closed on my original loan. And the reason I was able to do that is because I wasn't trying to time the market. I just did what was right in my life at that time. I needed a bigger house because I have 3 boys and my wife. We needed more space. We wanted a different location. So that's the things that we were focused on. I wasn't focused on the lowest monthly payment. Yeah, we all want the lowest monthly payment, but the reality is you can only take what the market's giving you at that time. But the key is being ready so that if and when the market gives you these dips, you're at a position to take advantage of them. Now, what happens to house prices if interest rates move down? Well, we all know that back in September, as interest rates moved down, we saw pending home sales climb. We saw mortgage applications climb. We saw a lot of people that were sitting on the fence get off that fence because there's a lot of people out there that still want to become homeowners and they just need that affordability piece. They need interest rates, their mortgage payment to be a little bit more affordable. So if you see interest rates come down in a considerable way, that means more competition out there in the market, more buyer demand. That's going to lead to price stability, if nothing else, at the low side, but probably home prices growing at a higher rate than they did in 2024. As I mentioned earlier, home prices grew at 3.6% based on the Case-Shiller index. And that's with interest rates averaging somewhere around 6.74%. So if we get the consensus of 6.34%, which is the average of where the majority of people think mortgage rates are going to end 2025, that likely means that you have home price appreciation north of 3.6%. And remember, for every 1% that interest rates decline, that adds 4 million potential home buyers to the market. And that competition is going to be fighting for the same home as you. Now, with lower rates, I believe that it also unlocks additional inventory. So you could see inventory growing at a time when the market is strong. But remember, all sellers are also buyers. They don't sell a home and become homeless. They sell a home and buy a home. So even though inventory is growing, one comes on the market, they're taking one off. But with that, I do believe lower rates leads to a stronger housing market because we already know there's a ton of people sitting on the sidelines. So where are experts predicting interest rates to go in 2025? Well, the most optimistic view at the moment is somewhere between that 5.75 and 5.8 range. Logan from Housing Wire is expecting a range somewhere between 5.75 on the low side, as high as 7.25 on the high side. Whereas the National Association of Realtors is expecting the low side somewhere around 5.8%. At the same time, you have Redfin, more on the conservative side, expecting interest rates somewhere around 6.8%. But if we took an average among 14 research groups that they tracked, the average forecast is expecting interest rates to finish 2025 somewhere around 6.34%. But the key thing to note here is just because it's a prediction or a forecast out there in the market doesn't necessarily mean that's going to happen. Last year, 2024, I predicted that interest rates would drop below 6%. In fact, I thought they would end the year below 6%. And while we did see interest rates drop below 6%, it happened in September rather than the end of the year. And by the end of the year, we saw interest rates shoot back up to some of the highest levels we've seen this year. So the key here is understanding that interest rates are volatile. There's a lot of different factors out there affecting mortgage rates. And there's that saying out there in the market that markets can remain irrational longer than you can stay solvent, which means things can be crazier way longer than you think. And in my opinion, interest rates fall right in line with that. None of us out there have a crystal ball. We're just looking at the economic data and making decisions based on that. But if I personally had to make a bet, I think interest rates are going to look a lot like they did in 2024, which means you're going to have periods of lower rates, you're going to have periods where interest rates move back up from those lows. It's going to be somewhat of a volatile year in interest rates. You're not just going to see a straight shot down to 6.34% at the end of the year, at least in my opinion, because I think you're going to get some better than expected inflation data, some worse than expected jobs numbers, and then all of a sudden you might get some better than expected jobs numbers, some worse than expected inflation news. And mixed in with that, we have a lot of unknowns about what's going to happen with the Trump administration. But understand, Trump coming in as our 47th president isn't going to impact the markets immediately. In fact, I believe a lot of the worst things that could happen while Trump is actually in office have already been built into the current numbers out there. Everybody thinks that inflation is going to get way worse, that all of these trade deals are going to go sideways, and that the market's going to go out of control in the wrong way. All of that's already been priced in. So the reality is, if that doesn't happen, then some of that will come out of the market and prices should improve. But here's the thing, none of that's going to happen immediately. What happens when he passes something in office in the first 30 to 60 days isn't going to have an impact in the market for probably 4, 5, 6 months. And as these things play out, it's probably going to have an impact on the bond market, which in turn is going to affect mortgage rates. So while I do believe mortgage rates are going to continue to improve, there's likely to be a lot of volatility while everything is playing out. So if you're somebody out there in the market that's looking to buy a home in 2025, my advice for you is to focus on what you can control. That's your down payment, that's your credit score. And in some cases, it's how much money you make. So focusing on those things are going to put you in a better position to buy a home when the time is right. And at the same time, if you're someone that's considering refinancing, speak to a lender now. Tell them what you're trying to accomplish. That way, as mortgage rates move lower, they can actually do the watching for you. You're not having to watch mortgage rates every day. One reason I was able to take advantage of lower rates is because I watch the market every single day. Most of you don't do that. So rather than try to be something you're not and watch rates every day, rather have a conversation with the lender now, get on their watch list so that when rates do drop, they can actually just reach out to you and start the process. Now, if you don't have someone to do that for you, my team would love to help, and you can reach us using that link in the body of the description. Now, with that, I would love to know where you think interest rates are going to end 2025. Do me a favor, let me know in the comments below.